Hello traders, welcome to another one of my videos. Today I'm going to talk about market structure. So market structure is basically for us to recognize if a market is uptrending or downtrending. On the uptrend, the market keeps carry on doing higher highs and higher lows, where on the downtrend is lower lows and lower highs. The way we can read price action in this case is that only when a higher high is formed that we can recognize the low, and as we can see, continue go forwards as well. Only this when this high high is greater that we can recognize the second high low. If we carry on doing this is an uptrend until the higher low after the high high is created. And there we could expect the market to carry on doing higher lows and lower lows. So lower highs and lower lows. As for on the downtrend, is only when the lower low is created that we can recognize the high, and then after the next lower low that we can recognize the next lower high. What we can do in these occasions is then when price is reaching the lowest point of the higher low, for example, on the uptrend, if the market keeps doing lower highs and lower lows on the inside of this structure over here, we recognize that this price is uptrending because until this low is broken, we still recognize that the market is uptrending. And another point I would like to make is that the lower the after the high is created, the lower it reaches this level, the most likely that we are going to obtain the best entry to go high and therefore taking profits at this higher high. Or on the downtrend, we go a low, we go a high, and then we go a lower low. Therefore, that's basically a lower high. And then what happens is that until that high low is broken, we will recognize or assume that the market should carry on going downwards. Same thing here when the lower low is created. It doesn't matter what the market does, up, down, up, down, up. As long as it doesn't break this lower high, we are going to assume that the market is going to continue on the downtrend. I'll give you a better example on the next charts. Excuse me. So if we go here on the uptrend, this is more or less how the markets react in live markets, give it or take. So as you can see, until this low is broken, we after this high is formed, we assume that the market is still going to go on an uptrend. Same thing here, higher higher low only after the high is formed, and then same thing here. As you can see, the market could carry on doing higher highs and higher lows inside uh, this market structure, and until that low is broken, we assume or we expect the market to continue to go up. Where on the downtrend is basically the same thing. It's just recognizing the market structure. We have a high, we have a low, we create a lower low, and therefore until this lower high is broken, we expect the market to continue to go downtrend, which is what happens over here. Same thing over here is created a lower low, and until this lower high is broken, we'll assume that the market is going to continue downtrend. Let's go through some examples. Let's go on the next one, and we go on a daily. This is Dow Jones. So let's map high highs and high lows. If we start with S, start here, we go low, we go high, and until this lower high is broken, we will assume that the market is going to be a downtrend because we're still on a downtrend at this breaker structure over here. So as you can see, the market could carry on doing higher highs and higher lows inside of this market structure, but until the market break this high, we will expect the market to continue to go downwards. What we need to understand is that, depending how you recognize market structure or market break, we need to understand if we are still on the high, on the uptrend or downtrend. So, for example, here we have created a new lower low. However, the price hasn't broke the structure through candle break, and therefore we will assume that that's the lowest point at this point in time. Therefore, anything at this, for example, points of interest, we will recognize that if the market reaches that point and makes some form of reaction, we should basically be setting up entries at those, not be, but as according to your strategy basically, and then probably target the lowest point because it gives you the most probability. Because the market, what happens with the market is that sometimes the market reaches to that lowest point, or as we can see here, reaches that lowest point and then possibly reverses and breaks this lower high. So if we continue with the market structure, we go here, market form other lower low over here, and therefore after creating this lower low, and for example in this occasion, what happened was that the market broke structure to the upside. So we would assume that the market has reversed. However, until this lower high is broken, we will assume that we are on a downtrend. However, at this occasion, the market actually broke structure to the upside, to which we can assume that now, if the market reaches this point, we should be on an uptrend anyway. However, as we can see, the markets are not always, or don't always behave as they should. And then what happened is that the market created a new lower low, and therefore we would assume that if the market would reach at this top of this candle, we should actually see a downtrend movement. But as you can see, we have broken up over here, but because this move is not enough to be considered a higher low, we cannot assume that if this is broken, we are in a downtrend again. But instead, the lowest point would be there. Therefore, until this structure is broken to the downside again, we will assume that the market is still on an uptrend. So anything that the market reaches, like points of interest to which we have to seem to have made some sort of reaction, we can assume that the market should, reach there, form some sort of pattern, candlestick pattern. For example, here we have a hammer, we have a hammer over here, and then we have downside move and then an engulfing candlestick to the upside, which means that we have more strength to the upside than to the downside, and therefore the reason why the market continued to go up. So if we continue to go through the markets, this is the new high. Then the high is broken over there, therefore this is the new low. And therefore, until the price either reaches this area, let me put on the square, it seems better, until a price reaches this area or that area to which we will assume that the market will react. In this occasion, it reacted at there, but it was a false signal and came out lower. Basically, what we can assume, which this is more, pushing into the smart money concepts, is swipe liquidity and reacted to the upside, creating a new high, a new high low too. And then until that gets broken, we are assuming that we are on an uptrend. This is not enough to consider it as a downtrend or a higher low. Still not sufficient. Therefore, we can assume that we will be on an uptrend at these points. If we go here, this is where it reacted from. New high, excuse me, and therefore until, so this is new high, new higher low. This, if you can see, the price reached there. It went a bearish candlestick and then an engulfing candlestick to the upside, and then carry on another break. I think we get the idea how the market structure works. This is just a simple explanation of how we can recognize market structure. Is that if the market is doing high highs and high lows, we have a high, we have high, we have a low. If the high is broken, we are on the uptrend. However, if the low is broken, we are on the downtrend. And carry on following the price, which is not always straightforward. We can recognize if we are on an uptrend or a downtrend, and then trading accordingly. With that said, thank you very much for watching another one of my videos. Thank you, and see you next time.